So please evaluate pre-tax profit ratio for the company and another things. Now this is not the problem to dealt with, because now we have the following issues. So size of currency exposure in each currency, preferred change of the exchange rate, appreciation or depreciation, and also we will have to add all the assessment here. Which hedging strategy is preferred by you? No hedge, total hedge, partial hedge. So instead of finishing our problem, now these three things will be heading 1. Okay, so there is excess numbering here. This is also deleted. I still keep the new launch vehicle design because this is what will generate the exposure for us right now. So, size of currency exposure in each currency. So, unfortunately I made the mistake that all the components is coming from the Eurozone. So, and then I'm not even using solid rocket boosters. So in my case, because this one is clearly produced and manufactured in the EU, that's why they did not finish in time at all. So I will import the structural elements, so the hull, the body of the rocket from the US for nice US dollars, because in this case I can generate some expenditures. So the company will import the elements piping, tubing, tanks, I mean fuel tanks and oxidizer tanks, oxygen tanks, and so on. In practice, that would be the most responsible thing to do, because this has the lowest added value possible. So this is what you can manufacture on site. On the other hand, this is where they are always going south. So many companies had issues that they focused absolutely on the engine or on the first stage engines, and after that their launches were failing miserably at the second stage because they tested everything at the first stage. So this can be also a problem when you are absolutely engine focused or first stage focused. So several $1 million were missed because of this behavior. So what can we see here? Then, in this case, we can see that this element and that will be affected. Okay, so we know that can see that sample setup. Let's use still the inflation data because this is what we have here, but let's fix. We will assume that the company is affected by inflation, but it still acts as a price, as an oligopolistic company. Still acts as an oligopolistic company, so practically our inflation just flows through the company and doesn't affect our profitability. So that's why we can use case study sample setup inflation here, and also I will save it as FX exposure. Yeah. oligopoly, competitive, so this is inflation added, this is where inflation is also added, and this is where we can see that new first stage number is written here. So we definitely need this data because this is how many things we have to manufacture for the first stage, and also first stage cost. Yeah, but this is with everything, so still I have to remove engine data. So let's create a new sheet, because now we have to see that a fixed exposure. Yeah. So what is relevant for us? Number of first stages, because this is okay. First, so relevant for us different years. Okay, then next thing, launch number doesn't matter, launch price, okay, and so on and so on and so on. So first stage numbers, first stage costs. Let's paste all the numbers. I don't want to refer it back to anywhere. So in this case we have to deduct engine cost, because at least I need only one engine, because this one is big. So what is the price for this one? 10. Okay, multiplied by this number here. So we need 4 engines in this year. So this is the price for the engine, and now we can see, and also we have to fix this one, otherwise we'd have 4. Now we can go this sideways, and then we can see that hull cost. You have an easier job in the case of you are using imported Merlin engines or other SpaceX related or foreign engines, because in this case just you have to calculate that how many engines you need. Just I have this issue, because for you it's just this line what is necessary, and after that you don't have to run any further calculations. But for me this is the exposure on one hand, because still I have second stage related stuff here, and we know that we are not able to recover the second stages. So this is how many second stages do we need. Yeah. So let's say new second stage numbers, and again we can grab the second stage. Oh my god, fuel. Why I added fuel as well here? Come on. Okay, so again we just have to add. Let's go back to the cost table. At least here we have the aluminium price. But I would have also the, okay, this price from here as well. Okay. Okay, so I have to fix this, multiply it with the number of launches. So practically, if I'm not completely lazy, and I'm saying that so price of this one is multiplied by the number to be billed. They should be the same. Yes. Okay. So all these things, what I did here, it doesn't matter because I have already the data from here. So, to costs, and now USD exposure is this number, and that number. For these years. So at the beginning, this is quite low, and then when the company is scaling up due to the not recovered second stages, so this is where we can see that if we would able to solve this problem, but engineering and physics are way harder in this case, so we are lazy and just focusing on the first stage, but still it can affect our exposure. So now we can copy this backwards to our company data, and still we can say that, okay, but we have numbers here, but what is the relative performance of this data? So we should maybe highlight this importance related to profit of the year, maybe. Just to see that. So okay, so so we can see that this can be quite relevant, so it's way above 5% or 10% of the annual profit what we are talking about. So if this thing changes, then it can affect our profitability. Ratio. And also, if we are just saying that, okay, let's compare it not to the actual profitability because it dynamically changes, so let's compare it to the total assets, so the size of the company, then I think it will be still way too big. So exposure divided by this number here. Okay, we are outgrowing this exposure. 1%, 3%. Yeah, so total assets. Yes.
I know why you are doing it, but isn't it like not correct to assume there's like a percentage exposure, because like the whole rocket can't fly without any pipes? Because like for example, when the US or something is importing the Russian engines, they can't fly at all. So like the exposure is actually 100% because the whole rocket can't fly without an engine or without pipes.
Yeah, just somehow have to include exposure to test. So yeah, so this is the arbitrary part of
and if we want to make it simpler for us and we use like methane, could we say we are importing methane from the US?
Yes, definitely. You can say, or you are just buying it for US dollars from the world market. Okay. So you don't have to even import it just because it's listed in US dollars, then you can say. I wanted to show something which is at least relevant at the level of profitability, and now we can see that, okay, we have to analyze this one. So US dollar exposure will be, let's keep it simple. not design, this one, and yeah. Okay, so size of exposure, I think we defined that this is the size of exposure. So now it's important to see that what is preferred by the company. The company the structural elements from the US, so it prefers USD depreciation against the euro. Okay, can we see this? So let's test this preference. Oh, by adding heading 2, just let's make this heading 2 nicer. And this is where we can start to add the different approaches. So let's see historical data. And we had this beautiful, this one? Not this beautiful. This one. Still we can say that let's be precise and let's add also the name. Is this euro US dollar or US dollar euro? Euro US dollar, okay. Yeah, okay, it's also written here. And this goes down. So, tester preference historical data, and we can see here that if it goes up, then it means there is euro appreciation. If it goes down, then it means euro depreciation. So, historical data, sorry, historical trend, we did not fit in the trend line. So let's say that our trend line and add the linear trend and display equation on the chart. I really hate linear trends, but here we can see that it's so simple. It even fits to the forecast. So then we can say, and this is what matters for us here. Because if this number is negative, then it means that there is a depreciating trend. And also we could say that, yeah, but what is the R square of this one? So actually, what is the accuracy? What is the R square? Display R squared value on chart. I'm looking on it, but whatever. So it should be nice. So there will be a problem, because still consider the depreciation of the euro, while we are saying that it's backwards. So this can be a problem. So let's see the rest of preference simulation. Okay, GJR-GARCH 111 simulation with skewed P residuals. So we are taking the most thick parameterization possible, or at least available for us, and let's see that what happens in this case. And we did this several weeks ago, and we were able to see nice things. So first of all, that was the fit. This is not the fitness data, this is the parameters of the model. So let's say some words about it, because yeah, so we were able to say that past weeks, and also we should say that what is the tested data, because I forgot to talk about it. And so we were testing weekly closing data of the Euro-USD exchange rate between 2006 and 2013 Q3. Okay. Now everybody will be happy, because there is also the data source, and now we can see that we were able to see past weeks. So now we know that this is weekly data, because we defined this here. And past weeks volatility had 78%. We know it because this is the number here. Influence on this week's I did this in the wrong place. So the volatility as the of asset pricing is persistent. Move the ball from here, just in this case we can see that. And also we know, I don't know nothing much about skewed distribution parameters, but what we know, or what should we know, that these things can be transformed to normal distribution. So if this thing is 0, then it's symmetric, and if this is something, then it should be normal distributed. So let's see, that skewed distribution. In the Wikipedia we should have something about this. Yeah. Okay, general skewed distribution, and maybe not this side. No. GNT distribution. There was something. Yeah. How about the parameterization? This is supposed to be infinite. I remember otherwise, but okay, so doesn't matter what we can see here, that this is not infinite and this is not zero, so practically we can say that we tested model with fat-tailed distribution to represent the frequent occurrence of extreme data. So this is why we use this, and still we can say that fat-tailed distribution we are just not using it because it's fun, but also because it's useful. Okay, this amount of information is completely enough about this, and now it's necessary to add the nice, come on, graph. What happened here? I did not copied everything here. Okay. Then let's run this again. Luckily that's why we have MATLAB here, because we can say that okay, if we need something then we can redo the whole simulation again, and we can have the HT, which is this number, and because I forget to copy it here long time ago, yes, now it's appropriate. Decimal points, decimal commas, and we are losing 1 day or 1 week of data because of the differentiation, and now we can have everything. The conditional variance of the data, we can use it later on during option pricing as well, so it's also really useful because now we can see that this is not constant and this changes in time dynamically, so if there is any recession. What happened here? Ah, this is when the Swiss franc was not fixed. No, that was in 15. In this case I have no idea what happened here, but so otherwise we can see that if there was a crisis situation, then volatility was reacting on this one, and now we can see also the result of the simulations with the parameters resulted the following scenarios. Portrait exchange rate, what we can use during, sorry, or future calculations. Okay, so now we saved already this data, so I don't want to change anything here. Maybe it would be wiser to include it as diagram, but in this case we can copy and paste the numbers if we need them, and we definitely need them in the future, so so let's keep it here. And also we can see that, yeah, this one is going upwards, so we can expect at least some kind of appreciation of the euro, so it's nice. This one is even nicer. In the case of pessimistic scenario, there is a depreciation, so this is not nice. So the pessimistic. Yeah, and then poor exchange rate. War model, which went absolutely sideways. I had big hopes for that one. This is the because at the end of the day we were able to see it only, but these were not significant, so let's just use them. So what we can use, let's go for investing.com, because at least they have nicely available data for us, so we just have to copy the last known data. I don't want to sign up, come on. Okay, January. Okay, let's say March. Then also here from the March. And in this case, let's also grab the March data, because it will be much more reliable. And this is the expiration date of the contract. So in this case we can say that if we are following the testing, investing.com, we have the following data. What can we see here? then the numbers are practically increasing. So market expects US dollar appreciation, sorry, euro appreciation. Okay, so now we have different parametrizations, different forecasts. If we would have a reliable VAR model, just we don't have, then we would add also that one, but this year we are skipping. The model, because it had no significant results. It's already in English mode, but somehow. Okay, so we need the conclusion. So even if the market, the futures market, expects euro appreciation, the company will use or will test its business plan. And just for fun, pessimistic. Just for fun, we will use only the pessimistic and the optimistic scenarios, because we can see that in the middle nothing happens, so it's practically it would be the same, so we don't want to test it. So confidence is business plan according to the pessimistic and the optimistic scenarios. Value, profit, and default. Okay. Then, which hedging strategy is preferred by you? Hedging, no hedge, total hedge, and so on. So, first of all, we have to check all of them. So, no hedge. This is started. According to the optimistic and pessimistic scenarios. Yeah, now we have to modify. So where are you? This is where we have the data. So now we just have to integrate all these nice and beautiful things into our own profit and loss statements. Do we need this anymore? No, we don't. And yeah. PLS, please. So maybe I will grab this one and relocating it to here, because at least in this case we can see what is happening with our eyes directly, and I don't have to jump back and forth between different setups. So we don't want to care the middle, because practically nothing happens there, nothing dramatic happens there. In this case we can see that how it effects. So this is where drama happens. So yep. Okay, first stage cost. So we have to modify everything. Or we can be lazy and we can say that, oh, we have already the exposure data. So let's just add the difference. So how it changes, because right now exchange rate is 1 to 1. So if we are just saying that, okay, this will be the change against 1 to 1, just multiply the change with this number, then actually we can see that how the exposure affects our expenditures, and we don't have to dig up everything in the profit and loss statement, just some parts of it. So yeah, this is where we can say that let's add insert new things. FX exposure and blue. Well, let's use blue. So first of all we have to say that 1 minus this thing. So this is the pessimistic scenario, so come on, you are not percentage anymore. Okay. Or a number with 2 digits. So we can see that, okay, there is depreciation of the euro, then this is what will increase here, and then we can say that multiplying u with the already generated exposure data, then this will generate such a loss. So we need something negative, so let's say that if I'm -1, then this will be negative, so I don't need any further -1s. Nicely it increases, so we can see, and also let's check that it's real. Okay, we can see it's real because this here is a big number, this one is a smaller number, and also we can see that it's nearly half, so it's reliable, so we don't have much mistakes here. And now we just have to add it because this one is already negative, so that's why it's plus. If it would be a minus, go here please, then we would have issues. Okay, so what was it before? It was 300, now it's 600, so it's decreased. Good. Profit for the year. Not good anymore. And now we can have also some data. Nope. All my beautiful designs are diminishing right now, but yeah. What is this? Profit? Yeah, this is the profit for the year. So we just have to continue the data collection because we can see that, yeah, this is the profit for the year. Pessimistic, oh come on, how many times do I have to correct this typo here? Pessimistic ethics. Okay, but we have also changes in terms of now this was the value. Oh, this is the value and this is the probability of default. Okay. Sometimes I'm creating such ugly things. Okay, but pessimistic. Yep. So let's go to the value and let's grab also 300 something. Okay. 3000. We can live with that, just before falling from this to there with the oligopoly. So, yeah. And also we need the probability of default from here. That one. Yeah. Now we are cool. And not cool because still formatting is required. So, yeah, it has been increased slightly, but practically doesn't matter so much. So we have even under pessimistic scenarios, yes, in the first year we are in losses, but we were already in losses, so it doesn't matter. And then we can live happily and count our money later on, and practically the value is not affected dramatically so much. Okay, let's see the optimistic scenario. Yeah. In this case, again, let's say that I don't want to dig up everything, so let's just say that from pessimistic we are just moving it down to optimistic, then rolling sideways, then we will create, suddenly it will generate profits, obviously, because now we are gaining money because of the exchange rate, so this is the gambling part. And so just some side notes for the future. Yeah, and this is just one note. So in this case, still we can have to grab the profit of the year. We have happy profit of the year. It's even better than before. Oh, nice money. And then we can say not you. Oh. And last thing. So if we are doing nothing at all, and we are lucky also at the same time, absolutely lucky, then we can see that we can generate a lot of money, the value of the company will explode, and also the probability of default will be way lower. So now we just have to transform everything to new graphs. Not update these ones because they are inappropriate. And let's compare everything to the oligopoly because this is the baseline scenario. So we just have to say that profit of the year. This is the data. That's how I was defining at the beginning that we are just focusing on the oligopolistic case, because otherwise it would generate so many different kind of outputs and value. If you have time at home, then you can play with even more data, just we don't have time. So probability of default? Yes. No. And also, yeah, I was able to see it many times, but it's always not nice that if we have scares between 0 and 100, it's always better to show that. So politicians are usually doing this, that they are not using the whole scale, because in this case you can increase the differences. What we can see here right now, that if we are not politicians, then practically the difference is not so much. If we are looking at what will happen with the probability of default, nothing, because the company is already healthy. So we are generating more money or even more money. That's the difference. That's why I don't like when people are saying that government should be involved actively with foreign exchange rates, because it supports companies. And no, it supports poor performing companies. If a company is performing nicely, then they will be a happy company, doesn't matter what, because they are growing because of productivity and not because of playing with exchange rates. Now we have to write this down nicely. So assuming since the company has improved its profitability a lot with their new launch vehicle, nice simple, with their new launch vehicle, the fixed exposure has no neither of their financial characteristics. Neither of their financial characteristics. Okay, yeah, good enough. Don't need them anymore. Oh, come on, still I have things here. Sorry, guys. Then still we can see that this is actually completely up to the management, that what is preferred by them. So the management still have the discretionary right to say that still I don't want to run all these exposures. So the has the right not to gamble with shareholders' money. On FX markets, so they can choose to fix the exchange rate, let's say the whole exchange rate exposure with an option for the next 5 years. At what is our preferred exchange rate here? Obviously the neutral would be 1-to-1. Obviously if you would like to make some money, then it could be, let's be greedy, but let's say we would like to fix it to 1.1. Because already we can see that this is what the simulation is saying here, so let's earn some money. because we were able to see that if this appreciation happens, then yeah, the company is even more happier. So, and we like happy company, happy shareholders, because that it can create happy bonuses for the management. So FX exposure option, because now we have just one simple thing to do here. FX rate with option. That's the easy way, because we can say that, okay, I could decide so many other things, but right now let's say that I did this, so let's test this. Okay, so now the FX exposure, you are coming here, now you're rolling through sideways. Okay, I'm generating less profit because of there is no this monstrous appreciation anymore, just a happy one. And still we need hedging exposure, so option fee. Let's highlight it with blue as well. So we have to calculate the option fee for that time. Yeah. I close it. Yes, I close it. Okay. Did I save it last week? No, I didn't save it. We were just calculating without any outputs. Okay. So, it's really funny because yesterday I had investments class with the Hungarian finance master students, and they were saying that they were checking last week's or 2 weeks ago's video about this class because it helped them to write their own homeworks. So this is funny when they are just looking forward to have their work moving forwards, and it was absolutely non-intentional, but quite a genius solution because they were able. Oh, so they were able to avoid some works because we already did this here. Okay, so we need option fee, we need obviously volatility, so let's calculate volatility, and then we should calculate Garman-Kohlhagen model and also the other one, because we know that everything will be fancy. We have some kind of prices here. Yes, because we already had the for option fees for 5 years ahead. So yes, come on. I don't need this one. We need this. Okay, let's copy here because all the exposure thingies are located here. So, oh come on. So this is when we have to open our notebook or notepad, sorry, and we can say that instead of space we need tabs. Then we have to exchange this tab, and then we will use this, but not now, because now we should calculate also the Heston option fee, and we know that Heston option is here as well. So let's copy it also here. Now we have all the data with spaces, but we need tabs between them, because in this case we can fix them into no space, replace all. Oh my, it was more than one space. So remove the excess spaces or excess tabs. Okay, so now we can copy them here, and they are behaving nicely because Excel always recognizes tabs. Garman-Kohlhagen option fee, Heston option fee, And now we can just say that. Let's copy them, not here, here. Let's locate it in the middle. Let's add a nice yellow color, because in this case we can see that this is what we are looking for. And now, okay, so now we know that what is the option fee. So first of all, we will use Garman-Kohlhagen option. So this is the value for each euros, for each US dollars, and there is the exposure. So this is the exposure, this is what we would like to fix. So yeah. And this is oh yes, it's already recognized by the function. So it, until now it was just sleeping, and now we can see that, and that was the Garman-Kohlhagen option. And yeah, it was changing a bit. I made this already. It's adapted. Okay, so now we just have to finish the documentation within 10 minutes. So total hedge. Okay. We have the following. Option fees by using the, no way I will write this one. Garman-Kohlhagen model. And the Heston models. It's good for you because it will be absolutely the same for each team, so you can reuse this table, obviously. Also, you can use the exchange rates and all the other things as well. So this section, this whole section is the same for all the teams, because that's an external input for the data. After that, yeah, this part is the corporate specific part here. But this is general for everybody. What is happening with the option fees? This is definitely. I'm still running in English mode, but for some reason it's not recognizing this. And yeah, it's ugly. Insert one row above, so now we can see 1, 2, 3, 4, 5 here. Oh. Nearly made a mistake. Huge mistake, because start price is not asset price anymore. Start price is 1.1. Asset price is also not good. Nearly. Oh, this is, asset price is good because right now this is what we have at the market, and this is what I would like to fix. The rest is good. So we just have to make this one but really significant change here. So let's copy it back to our notepad here, and also this is not the case. 1.1. It was point, right? This is point. Okay, now we just have to make the space to tabulator changes again, just now by deleting the excessive spaces. replace space with tab. Yay! Decimal comma point change, then this change, still yellow. Okay, that's why I was really lucky not to build up everything right now, and we just have to also change the data here. This is how I nearly messed up everything. Okay, so now to multiply the exposure of each year with the option fee to have the options in each year. So this will be hedging exposure. Let's create a graph. And let's also add euros, so we are not talking about bread or something, but we are measuring it. Million euros, this one is obvious that we are talking about years, I think so. Okay, and now we just have to comply profit for the year, Garman-Kohlhagen option, and we will have also the Aston option. So, what is the value? No, we are already here, so what is the probability of default? And what is the value? And also we can see Heston option. So for the Heston option, we just have to move this one down a bit, sideways. Yeah, Heston option is more expensive because it contains much more parameters about volatility, so obviously it will be much more careful when we are valuing it. So anytime if you are signing out an option or selling an option, then Heston is much more better because you can secure yourself, or at least price in unwanted risks. What I'm doing here, I should copy this one. So much better than with the Garman-Kohlhagen. Okay, this is percentage. Can I extend this? Maybe I could just faster if I'm click on everything. Yes, additional charts. Here were more lines. Profit for the year. Value. Probability of default. Copy, copy, copy. Can we see any difference? So somehow they should be somewhere in terms of profit, just we cannot see it because they are overlapping. In terms of value, yeah, they are somewhere in between. In case of probability of default, we are also not able to see it, so we can say that the profit and the previous scenarios and the value is similar. Original. However, the management is not running. Anymore. Okay, and since we are running out of time, exchanges management, third one, no partial hedge. Yeah. Because in this case we would, unfortunately right now we don't have partially hedged data because we should simulate also that what is happening if in 1 year something strange happens, but this is not allowed by or to get something. So at the end of the day still we need one conclusion, because we generated many things, but the management, the usage of the total hedge strategy, because simulations warn them that FX rate fluctuations can generate volatility. The fundamental characteristics of the company. Yeah. This choice will generate additional expenditures, but it is compensated by the preferred and fixed 1.1. Yay! So we generated a slight appreciation, artificial appreciation due to the options, and at the same time most of it was used up by option fee, but still we can happily live with that. So we can see that we were able to avoid this situation. We were not able to achieve this one, obviously, and but profitability of default it's lower. So yeah.